Here's a question most Americans never think to ask. What if your credit score isn't really your score? What if it's more like a price tag, one the lender reads and you don't? A number that determines whether you pay 6% on a mortgage or 7.5%. A number that looks objective, feels permanent, and is quietly costing you more money than your car. Most people treat their credit score like the weather, something that happens to them, something that moves slowly, unpredictably, beyond their control. They wait years for it to improve. They follow the standard advice. They do everything right. And they still end up overpaying by 6 figures on the exact same house as someone who simply understood the rules better. Today, we're going to talk about what those rules actually are. Not the version the bank explains, the real version. Let's start with something uncomfortable. The credit scoring system was not designed to help you. It was designed to help lenders, specifically to help them decide how much to charge you. That distinction matters more than most people realize. FICO, the company behind the most widely used credit scores in America, was founded to serve creditors. Banks, mortgage companies, auto lenders. They are the paying customers. You are the product being evaluated. So when you're told to build your credit responsibly and wait patiently for your score to improve, understand who that advice benefits most, because every month you spend sitting at a 680 score instead of a 780 costs you real money. Not theoretical money, not someday money. Money leaving your account every single payment cycle, quietly and without ceremony. Let's make that concrete. On a $350,000 home, the difference between a 6.5% mortgage rate and a 7.8% mortgage rate is roughly $190,000 over 30 years. Same house, same neighborhood, same income. Different score, different knowledge, different outcome. That's not a rounding error. That's a retirement account. And the slow, conventional path, the one everyone recommends, keeps ordinary Americans sitting in that gap for years longer than necessary. Pay on time, keep balances low, don't open too many accounts. Wait. That advice isn't wrong. It's just conveniently incomplete. Because there are mechanisms built directly into the credit scoring model that allow for dramatically faster improvement. Legal mechanisms, documented mechanisms, mechanisms the lending industry understands perfectly and has zero financial incentive to explain to you. The gap between people who know these mechanisms and people who don't translates directly into a wealth gap. Not a small one, the kind measured in hundreds of thousands of dollars across a lifetime of borrowing. Here's the deeper problem. Most Americans assume the system is a meritocracy, that if you're responsible long enough, the score will eventually reflect that. And it will, eventually. But eventually is doing a lot of heavy lifting in that sentence. The credit scoring algorithm doesn't just measure who you are today. It measures the age of your accounts, the depth of your history, the length of your relationship with credit. And that's where most people get trapped, not because they're irresponsible, but because they're starting from scratch while the system rewards people who've been playing the longest. There's a way around that, and it's hiding in plain sight. Let's talk about the specific feature of the credit scoring system that most consumers never discover. It's called authorized user status, and understanding how it works requires understanding one thing first. Roughly 15% of your credit score is determined by the age of your accounts, not just your oldest account, the average age of everything on your report. Most people assume this is simply a function of time. You opened your first card at 22, you're now 31, so you have 9 years of history. Nothing to be done about it. Just wait. That assumption is wrong, and the error is exactly where the opportunity lives. Here's the mechanism. When someone adds you as an authorized user on their credit card account, that account's entire history imports directly onto your credit report. Not from today forward, from the day they opened it. The account's age, its payment history, its credit limit, its utilization, all of it appears on your report as though you had been part of that account from the very beginning. Read that again slowly. If your father has a credit card he opened 26 years ago with perfect payment history and a balance under 5% of the limit, and he adds you today as an authorized user, that 26-year-old account appears on your credit report. Your average account age could jump from 3 years to 14 years almost overnight. Your total available credit could double. Your longest account history could extend by decades. Within 1 to 2 billing cycles, your credit profile looks fundamentally different, not because anything changed about your behavior, but because you understood how the calculation actually works. This is what thousands of financially informed Americans do quietly, while everyone else waits patiently for time to do its job. Now let's be precise about what makes an authorized user account actually useful. The account must have perfect or near-perfect payment history. Any missed payments import alongside the positives. The utilization on that account should be low, ideally under 10%. The account should be old. The older, the more dramatic the impact. The issuer must report authorized users to the credit bureaus. Most major issuers do. American Express, Chase, Bank of America, Capital One, Discover. Smaller institutions vary. Always verify before executing. Here's what makes this strategy low risk for everyone involved. The primary account holder never has to give you a physical card. They can add your name to the account purely strategically without giving you any actual access to their credit line. And if circumstances change, they remove you. Simple as that. The account eventually falls off your report. No permanent commitment, no financial exposure. Just a transfer of decades of creditworthiness in about 10 minutes online.
Let's move to the second mechanism. This one requires no family members, no conversations, no favors, just a change in timing. Most Americans who use credit cards responsibly pay their balance in full every month, never pay interest, never carry debt, and still get penalized on their credit score. Here's why. Your credit utilization ratio, which accounts for roughly 30% of your score, is not calculated based on what you pay. It's calculated based on what gets reported. And what gets reported is the balance on your statement closing date, not your payment due date. Those are two different dates, and most people don't know the difference. Here's what that looks like in practice. Say you charge $2,500 per month on a card with a $4,000 limit. You pay it in full every single month, never pay a dollar of interest, perfectly responsible by any reasonable standard. But your statement closes with that $2,500 balance showing. That's 62% utilization, reported to all 3 credit bureaus every single month. Your score is being quietly punished for behavior that is objectively responsible, because the system doesn't measure responsibility, it measures the snapshot. The fix is straightforward. Pay your balance down before your statement closing date, not before your due date, before the statement closes. If you reduce your balance to somewhere between 1 and 3% of your limit before that closing date, that's the number that gets reported. That's what the bureaus see. Your score could jump 20 to 40 points within a single billing cycle simply by changing when you pay. Same spending habits, same income, same card. Different timing, dramatically different score. Set a calendar reminder for a few days before each statement closing date. Log in, pay down the balance. That's the entire strategy. Now let's layer on something that amplifies this even further. Utilization is a ratio. You can improve it by reducing the numerator, your balance, or by increasing the denominator, your credit limit. Most people focus only on the balance side. The limit side gets ignored entirely. Here's what most cardholders don't realize. Many major issuers, American Express especially, will approve credit limit increases with no hard inquiry on your report. A soft pull only, zero impact on your score. You request the increase through the app or website, they review your account history internally, and they often approve significant increases quietly. Doubling your credit limit instantly cuts your utilization ratio in half. No change in spending, no change in behavior, just better math. Request limit increases across every card you carry every 6 to 12 months. Over a few years, someone who started with $10,000 in total available credits can accumulate $40,000 or $50,000 in limits simply by asking periodically. Banks don't advertise this. Higher limits mean better scores, which means customers qualify for better rates elsewhere. That's not in the bank's interest, but it's very much in yours. Let's talk about what goes wrong, because these strategies work, but they work precisely, and the most common mistakes don't just slow down the results, they actively reverse them. The first mistake is choosing the wrong authorized user account. This sounds obvious, but people get it wrong constantly. They ask a family member for help without actually reviewing that family member's account, and they import a problem instead of a solution. An account with high utilization hurts your score. An account with even 1 or 2 missed payments in its history imports those negatives alongside the positives. An account that's only 4 years old provides minimal benefit if you already have accounts that age. Before you ask anyone to add you, you need to know 3 things: the account's age, its complete payment history, its current utilization. If all 3 aren't favorable, keep looking. The second mistake is applying for new credit while executing these strategies simultaneously. Every hard inquiry on your report temporarily reduces your score by 5 to 10 points. Opening a new account reduces your average account age. People spend weeks carefully optimizing their authorized user strategy, then walk into a furniture store, get talked into a store card for 18% off a couch, and undo a month of progress in 60 seconds. No new credit applications while you're optimizing. That's the rule. The third mistake is inconsistent utilization timing. Paying before your statement close date works only if you do it every single month without exception. One billing cycle where you forget and your reported utilization spikes. That spike appears on your report, your score drops, and the month you needed to look your best is the month you looked your worst. Set automated reminders. Treat the pre-statement payment like a bill, because in a very real sense, it is one. The fourth mistake is impatience combined with premature action. These strategies work within 1 to 2 billing cycles. That's fast by credit standards, but it feels slow when you're anxious. People pull their credit report after 3 weeks, see no change, and conclude the strategy isn't working. Then they abandon it, then they start over, then they wonder why nothing improves. 2 full billing cycles. That's the timeline. Pull your reports after that window, not before. The fifth mistake is ignoring errors on the report entirely. Studies consistently show that a significant percentage of American credit reports contain at least one material error: accounts that aren't yours, balances reported incorrectly, payments marked late that were made on time. These errors sit quietly on your report, dragging your score down while you focus on optimization strategies above them. Before executing anything else, pull your free reports from all 3 bureaus, review every line, dispute anything inaccurate through proper channels. Clean foundation first, strategy second.
There's one more mechanism worth understanding. Most consumers never hear about it, not because it's complicated, but because it only becomes relevant at a very specific moment, and by the time most people learn it exists, that moment has already passed. It's called rapid rescoring, and it exists specifically inside the mortgage application process. Here's the problem it solves. Normal credit report updates happen on a billing cycle schedule. You pay down a balance today. Your issuer reports the updated balance next month. The bureau updates your file shortly after. From action to score change, you're typically waiting 30 to 60 days. When you're in the middle of a mortgage application, that timeline is a problem. Interest rate locks expire. Approval windows close. Sellers move on. 30 days might as well be a year. Rapid rescoring compresses that timeline dramatically. Here's how it works. Your mortgage lender, not you, can request that credit bureaus immediately update specific items on your report based on documentation you provide directly. Pay off a credit card balance. Provide proof of the zero balance. That updated balance can appear on your report within 72 hours. Not 30 days, 72 hours. Become an authorized user on a parent's account. Provide documentation. That account can reflect on your report within days rather than waiting for the next billing cycle. The combination of strategies executed within a rapid rescoring window can produce score improvements of 50 to 80 points during the application process itself. That's not a small number. 50 points during a mortgage application could be the difference between a 6.2% rate and a 7.1% rate. On a $400,000 loan over 30 years, that difference is roughly $140,000. One conversation with your lender, one documented payoff, one rapid rescore request. $140,000. Now here's the critical detail most people miss. Rapid rescoring is not available directly to consumers. You cannot call the credit bureau and request it yourself. It only flows through licensed mortgage lenders during an active application, which means the timing of your optimization matters enormously. Don't finish all your credit work months before applying, then hope the score holds. Coordinate your final improvements, your last balance paydowns, your authorized user additions to happen right at the beginning of your application window. Then, ask your lender explicitly about rapid rescoring. Most borrowers never ask, most lenders never volunteer the information, but it exists, it's legal, it's fast, and it's available to anyone who knows to request it. That's the pattern you'll notice throughout this entire conversation. The tools exist inside the system. They're documented, they're legitimate, they're accessible. They're just never advertised by the institutions that profit from you not using them. Let's zoom out for a moment, because everything we've covered today isn't really about credit scores. It's about the cost of not knowing. Every financial system you interact with in America has a visible layer and a mechanical layer. The visible layer is what gets explained to you. Pay on time, stay under 30% utilization, be patient. The mechanical layer is how the system actually calculates, actually rewards, actually penalizes. Most people spend their entire financial lives operating only on the visible layer, and they pay for that gap, quietly, continuously, compounding over decades. The difference between a 680 score and a 780 score isn't just a number on a screen. It's the interest rate on your mortgage, your auto loan, your home equity line. It's your insurance premiums in most states, your apartment security deposit, your small business financing terms. Every one of those costs compounds across a lifetime. Someone who maintains a 780 score instead of a 680 score will likely keep hundreds of thousands of dollars that would otherwise transfer quietly to lenders. That's not an exaggeration, that's arithmetic. The strategies we discussed today are not shortcuts. They are the actual rules read carefully by people who understood that the simplified version was never written in their favor. Authorized user accounts, utilization timing, credit limit increases, strategic account management, rapid rescoring. None of this is complicated. None of it requires significant money up front. It requires attention, precision, and the willingness to understand a system that was never designed to explain itself to you. Pull your credit reports this week, review every line, then start.